This is a brief overview of Chapter 18, Module 4 topics. In this module, we're covering the recognition, initial measurement, subsequent measurement, and derecognition activity in the stockholders' equity accounts and introducing two new financial statements. If you're looking at the picture, you're seeing the statement of stockholders' equity. This is one of the statements that we will introduce and that you will produce for your semester project. Each column across the top of the statement of stockholders' equity is a balance sheet account that is part of the stockholders' equity section of the balance sheet. I want to quickly talk about each one and what we will cover in this chapter related to each. Starting with common stock, this is the account that keeps track of the shares issued to common stockholders. Companies receive cash from issuing common shares in what is called the primary market, where the company sells directly to investors. And there is usually a par or stated value required by the company's state of incorporation. The common stock accounts hold the par amount for every share of stock issued. After the initial issue of the shares, the company's common stock account will remain unchanged by the trading activity that you see or hear reported on in the business news. Only issuing new shares or retiring shares will change the balance in the common stock account. Common shareholders are owners of the company and as a group are very powerful because they get to vote in and select the board of directors, those who are tasked with hiring and firing upper management. Another category that you might see in a statement but is not in this one on the screen is preferred stock. It's just another category of shareholder. The accounting is very similar to what we see in common stock, but these shareholders have different rights from an ownership standpoint. Most importantly, they do not typically have voting rights, but they do get their dividends before the common shareholders do. Preferred shares can be issued with a variety of rights and promises. Sometimes these rights seem indistinguishable from the promises made to debt investors, and there may be additional reporting requirements because of this. This next column, additional paid-in capital, this is a catch-all equity account where the money collected in the initial public offering of the stock is recorded. Not all of the money collected goes here, only the amount beyond what I described earlier as the par or stated value of the stock. Sometimes companies just report all of their capital received from owners as paid-in capital, essentially combining the common, preferred, and additional paid-in capital accounts for the financial statements. We will see several different kinds of paid-in capital accounts in this module. Treasury stock is the account used to keep track when a company buys its own shares back in the market. Just like any investor, the company has to pay market price when it decides to buy back its own shares. We have some activities that let you think about reasons why a company would buy its own shares. Treasury stock sits in the equity section, but it has a debit balance. That's why you see it here as a negative number in the statement. It makes total equity smaller. Dividends, not a column, but if you look at the rows, you'll see a row that says common dividends. Dividends are returns of cash, property, or stock back to the shareholders. The board of directors decides when dividends will be paid. They don't happen automatically. Dividends generally come out of retained earnings. You can see this coming out of retained earnings. We'll talk about cash dividends. You probably have seen this in your earlier accounting class. We'll talk about property dividends, which is when the company distributes assets other than cash, usually something easy to split, like marketable securities. And we'll talk about stock dividends. And this is when the company gives each shareholder additional shares of stock. This one doesn't really change total equity. It just switches some of it out of retained earnings into the paid-in capital accounts. Stock splits happen when a company decides that the price for shares in the secondary market, where investors buy and sell stocks, is too high to encourage trades. The company can say that each share is now going to be 2 shares, and this cuts the price of every share held in half. But everyone automatically has twice as many shares. Stock splits don't have any impact on the balance sheet unless the company uses a stock dividend to achieve the same result. So the other columns that you see here, there's the accumulated comprehensive loss, other comprehensive loss. This is the account that is going to be impacted by the statement of comprehensive income, which is a new statement for this chapter and one that you will prepare for your project. It's a very easy statement to prepare, but sometimes the acronyms that we use make it confusing. On this statement of shareholders' equity, you see this account called accumulated other comprehensive loss in this case. This is a balance sheet account that is analogous to retained earnings, but only for the items that flow through the other comprehensive income part of the statement of comprehensive income. So OCI is the acronym we use for other comprehensive income to refer to the temporary accounts that'll ultimately be closed into the balance sheet account, which we refer to as AOCI. We've seen journal entries to OCI in Module 3 from the fair value option on debt, and we'll see more of them in Module 5 when we talk about investments. There's also a column for retained earnings, and you have seen in your earlier classes a statement of retained earnings, and what you notice here is that the statement that you learned as the statement of retained earnings is really becomes part of this much bigger statement of shareholders' equity. Those are the main topics that we're going to cover. There will be some others that we talk about in separate overviews.